The Psychology of Money explores the relationship between human behavior and financial decisions, revealing the secrets of wealth accumulation and financial freedom. It delves into the mind game of wealth accumulation and the power to cultivate wealth and well-being through understanding the interplay of emotions, behaviors, and decisions. Lesson 1. The Never Enough Trap. How social comparison and envy cause people to take foolish financial risks. Social comparison can lead to risky financial decisions due to feelings of envy and insecurity. People often chase short-term gains, losing money and feeling less happy, as they lose sight of what truly matters. Bernie Madoff's Ponzi scheme, one of the biggest in history, was a prime example of this. Constantly comparing ourselves to those above us can lead to a constant need for more. To escape the never enough trap, it is important to write down a clear end goal, beware of social comparison, and remember that things in life are never worth risking, such as reputation, freedom, family, and health. Lesson 2. Understand true wealth. Happiness increases from having control over one's time, not showing off material things. True wealth is not about material possessions, but about saving and investing in assets like stocks and bonds. People are not impressed by others' material possessions, as they tend to buy things they don't need to impress others. Happiness comes from having control of our time, rather than income or other factors. The highest form of wealth is financial independence, which means having enough savings to give us a sense of freedom, flexibility, and security. A high savings rate is the most important tool for accumulating significant wealth, as lifestyle expenses grow faster than income. Reducing desires and ego can help save more money and reach financial independence faster. Lesson 3. Compound interest is unbelievable. Warren Buffett's real secret is not investing genius, but consistency over a long time. Warren Buffett's colossal fortune is not due to genius, but his consistent investment approach that leverages compound interest's power over decades. What is compound interest? Imagine having $1 at the beginning of a month and compounding it by 2x every day. At the end of 30 days, you'd have over $1 billion. However, if you started compounding just 1 week later, you'd have just over $8 million. This is because compound interest is like money making its own money, growing each year by earning interest. As time goes on, you make more money by earning on top of your existing income. Warren Buffett's financial journey began at age 10, reaching a millionaire by 30, $25 million by 40, $1 billion by 56, and now worth over $110 billion. His secret to wealth is not investment genius, but his time invested in the market, allowing compound interest to grow. Buffett's average annual return is 22%, compared to Jim Simon's 66%. The practical takeaway? Start saving and investing now to increase your wealth and time in the market. Choosing the right type of investing, such as stock index funds, can reduce risk and provide strong diversification, with average historical growth of over 10% per year, despite volatility. Lesson 4. Make room for the unexpected. Secure your financial safety with a margin of safety for errors and tough times. Some investors lose money in stocks due to panic-driven decisions, while others gain wealth. This article teaches how to handle market fluctuations and avoid common mistakes in investing. Everyone has a plan until they get punched in the face. Mike Tyson. Investing can cause emotional pain due to market volatility, leading to fear, self-doubt, and instability. To reduce this, it is important to have a margin of safety, choosing stable, low-growth investments like bonds to create a safety net and avoid panic selling during downturns. Maintaining larger cash reserves, such as a $1,000 mini emergency fund, is also recommended. Underestimating future earnings by 1/3 can help avoid retirement and running out of money. It is important to differentiate between getting money and keeping money, as getting money often involves optimism and risk-taking, while keeping money requires recognizing past success and preparing for future challenges. Lesson 5. Recognize luck and risk. Success is not just hard work and skill, it's also about timing and circumstances. Success and failure are influenced by factors beyond our control, such as luck and risk. Bill Gates' success is a prime example of luck, as he was in the right place at the right time to have access to a computer in a school. It's important to remain humble in success and be kind to yourself in failure. On the other hand, risk can arise from making the right decisions and working hard, as demonstrated by Kent Evans's tragic death in a climbing accident. Recognizing broader patterns and focusing on what's in our control can help avoid being fooled by luck and risk. Lesson 6. Tail events. You can be wrong 99% of the time and still end up ultra-successful. Tail events in business and investing refer to rare situations that significantly impact an investor's fortune, either making them wealthy or causing significant losses. Despite most investments either losing money or breaking even, a small percentage of these investments become Grand Slam winners. Here are some examples. Warren Buffett's portfolio consists of over 400 stocks, with most of his wealth coming from just 10 of them. Amazon's business strategy involves making small bets to find huge winners, like AWS, which has driven Amazon's growth. Venture capital investing expects most companies to lose money, but 0.5% of startups can become successful and return 50x their investment, making it a profitable venture. What are the practical takeaways from understanding tail events? Diversify your investments by making small bets in various stocks, using index funds for a 1% advantage. View frequent small failures as experiments that didn't work, but ensure the cost of these failed experiments doesn't financially wipe you out. Lesson 7. Don't fall for pessimism. Market downturns are scary but temporary. In reality, the long-term trends are positive. The financial news often features headlines predicting a market crash, reflecting the psychology of clicks rather than the economy's reality. However, long-term financial trends are upwards due to confirmation bias, where negative events are sudden and dramatic, while positive growth is slow and gradual. This fixation on the negative can influence decision-making, leading to overemphasis on potential risks and missed opportunities for long-term financial growth. To avoid the never-enough trap, focus on what you have regularly. Set up automatic retirement account contributions using online services like Betterment and Wealthfront. Build an emergency fund of at least $1,003, 6 months worth, to build a margin of safety and stick with your investing plan during market crashes. Lesson 8. Getting wealthy versus staying wealthy. Good investing involves not making bad decisions, but consistently not screwing up. To stay wealthy, one must be frugality and paranoia, fearing that they can lose money. Success in money comes from taking risks and being scared of losing it. To earn compounding results, one must stay in business, invest, and continue playing the game. True success and wealth are measured in freedom, not just spending. The key is short-term paranoia and long-term optimism. As the longer one plays, the more likely they are to see outstanding results. Lesson 9. Freedom comes first. Wealth is the ability to achieve what one wants, and happiness is a universal contributor to it. Control is the highest dividend money pays, as it allows individuals to do what they want, when they want, with who they want, and for as long as they want. Angus Campbell's book, The Sense of Well-Being in America, highlights the importance of having a strong sense of control in predicting positive feelings of well-being. Money's greatest value is its ability to give people control of their time, which is at the top of Maslow's hierarchy of needs. Financial minimalism emphasizes building freedom in life, as even if one loves their job, it can feel like it is hated in the future. Lesson 10. Man in the car paradox. No one is impressed with your possessions as much as you are. People often desire wealth to signal their admiration, but it's not always the case. Wealth is often used as a benchmark for others' desire to be liked and admired. People often think having an expensive car or a fancy house will bring respect and admiration, but it rarely does. The lesson is not to abandon wealth or fancy cars, but to be cautious in seeking respect and admiration. Humility, kindness, and empathy will bring more respect than horsepower. Lesson 11. Reasonable or rational. Aiming to be mostly reasonable works better than being coldly rational. Academic finance focuses on finding mathematically optimal investment strategies, but Morgan's theory suggests that people prefer strategies that maximize their ability to sleep. Reasonable investors are more likely to stick with their technically imperfect strategies, as they are more likely to achieve better long-term performance. Commitment to a strategy during its lean years is more correlated to performance than rational thinking. Historical odds of making money in U.S. markets are 50-50 over one-day periods, 68% in one-year periods, 88% in 10-year periods, and 100% in 20-year periods. Lesson 12. Surprise. History is the study of change ironically used as a map of the future. Stanford professor Scott Sagan emphasized the importance of not relying solely on historical events as a guide to the future, as it may miss out on outlier events and overlook structural changes relevant to today's world. Investment is not a hard science, and people's preferences for goods and services change with culture and generation. Over-reliance on investment history can lead to overconfidence and a misleading view of the economy and stock market. It is crucial to consider the more general takeaways when looking back in history. Lesson 13. Room for error. Planning on your plan is crucial as it allows for the acceptance of uncertainty, randomness, and chance. Benjamin Graham's concept of margin of safety, or room for error, is an effective way to navigate a world governed by odds rather than certainties. Forecasting with precision is difficult, but thinking about odds is the best approach. People underestimate the need for room for error in financial matters, as demonstrated by Harvard psychologist Max Bazerman, who found that most people estimate projects to run 25% to 50% over budget when analyzing others' plans. Lesson 14. Nothing's free. Everything has a price, but not all prices appear on labels. Maintaining a long-term outlook in investing involves understanding the price of volatility, fear, doubt, uncertainty, and regret. Successful investing demands a price, which can be accepted or avoided. Some investors choose to trade in and out, attempting to get returns without paying the price. However, the money gods do not reward those who seek a reward without paying the price, as some car thieves will get away with it, while others are caught and punished. Lesson 15. The Seduction of Pessimism. Optimism is a belief in the likelihood of a positive outcome over time, while pessimism is a belief in the unpredictability of setbacks. Both are often influenced by money and market trends, and pessimist narratives are easier to create due to their recent and fresher content compared to optimistic narratives.